Hi, I'm Mitch Kramer, and joining me on the February 2025 webinar is Trey, Talley, Portfolio Manager for Fluent Financial. This webinar will be significantly shorter than last month's. We covered a lot of data. We're going to go through the same economic data, point out some positive trends and some negative trends, talk a little bit about the impact of the Trump inauguration, some of the changes they've made to date. I still think it's a work in progress. We feel the progress is good in the short, medium, and probably help in the long term, but it's going to be a bumpy ride. I think there's going to be some opportunities we're going to see overseas. We've started to kind of play in that area a little bit. So we'll go ahead and get started. First slide is the compliance slide. The information provided by myself and Trey is our opinion. It's not private client services. And with that, I'm going to turn this over to Trey. You can kind of talk a little bit about this first slide and provide a little more insight what we're going to be talking about today.
Thanks, Mitch. Hello, everyone. So here we'll talk about kind of what's going on in the economy and markets. New administration coming in, changing of the guard. We'll talk about how that's influencing both the Fed and politics there. Looking at kind of three-year returns. Starting to sing a different tune this year, but it's been dominated by the large cap growth stocks. It's been kind of a narrow participation where small caps, value, international has really not kept up. Bonds have definitely suffered over this time as inflation has been with us and lingering. Getting some progress there. The path to 2% is still intact. It will be a bumpy ride there. We're a little entrenched around 3%, which is a little uncomfortable for the Fed. But that's kind of the high view there. We'll go ahead and look kind of at the next slide there, which is where we want to contrast the leading economic indicators and the markets. And so we've been kind of very cautious on the economy because that has continued to be weak, primarily in the manufacturing sector. But as you see in the white line there, the index continues to move lower. There's quite a dislocation between where the economy should be going and where markets are going. That's opened up a really big valuation gap there, a lot of optimism built around the AI narrative over the past 18 months or so. So this gap generally does close, as you can see, going back to 1960, and that could happen through a function of improving economy, weak markets, or a combination thereof, the two. Right now, we're starting to slow down a little bit here going into 2025. We'll talk about some of the things that are influencing markets there. Returns is on the next slide here. And so this is that different tune that markets have been singing that I alluded to moments ago. So on the left portion there, you'll see just a number of different indices. And so this year, as we start off 2025, about 6 weeks in or so, we've really seen kind of a weakness in what has been strong over the past 2 years. So your S&P and your NASDAQ have really been the leaders over the past 2 years, and coming into 2025, they're more of a laggard with the NASDAQ up 3.4% and the S&P up almost 4.2% for the year. What has been doing well is international stocks. That is new. That is something that is a leadership that's not been with us for several years. It's not new in terms of the market history over the past 60 plus years, but it has been for the past few years. So that's worth note. Small caps are still kind of suffering there, just up about 1.5% year to date. As yields have risen, that's putting a lot of stress on the companies whose cost of capital is a little higher, earnings are a little weaker. And so small caps are trying to limp along here. Bonds are up on the year as we've kind of reset off of higher yield levels earlier in the year. But our portfolios, the more passive stuff's kind of humming along just as it should. Our active portfolios like V&O and ADVP, there's a lot of activity in them this year. We're starting to find returns come easier to us. We have been slowly shifting towards lower risk areas of the market that still can offer some material gains. And so a lot of our gains for the year have come from outside of our borders. We'll give a little more color on that through the balance of the year. But so far, a good start to the year. Some of the more active portfolios are outperforming some of that overvalued tech stuff we want to get away from. We want to avoid some of that risk without sacrificing too much return. So far, so good there.
Yeah. So we'll go to the hope slide next, Trey. And again, this is the third year for this, and we still don't see a recession on the horizon, but employment is still kind of lagging. I'm going to let you kind of go through the housing and the other elements of the hope slide.
Yep. So here we are, starting the hope slide. We focus on conditions, not necessarily timing of them. We don't pretend to have a crystal ball. What we preach is that conditions that generally are conducive to strong market returns and a strong economy are just not present today. This is evident in the hope cycle, starting with housing. This is the home builder sentiment. Above 50 is good. We want to see that. That's home builder sentiment improving, and below that, vice versa. We've got a reading of 42 here, so we're pretty solidly negative, and the trend has been lower. There was a lot of optimism that said, well, rates are kind of backing off a little bit. We've got a new administration coming in. Surely we're going to see a a rebound in housing activity. That's not been the case. And so very weak here. We also corroborate that with building permits on the next slide here. Building permits still moving lower, not much of a bump up there. Housing starts came in a little weak this week, and that actually kind of reduced the first quarter GDP estimates there. So housing activity continues to suffer with high interest rates, high input costs, and now rising inventory of new home inventory. And so a lot of home builders, if you're noticing out there, some of the home builder stocks have had a tough go at it. Some of the drawdowns are getting pretty steep, 20 to 50% in some of those stocks. Earnings and margins have really taken a hit there as demand is starting to slow. We want to see the exact opposite, to say the economy is doing great, go and take risks. We don't see any of that in the housing sector. Orders is the new section here.
Yeah, well, Trey, before we go into the orders, I think an important point to tell everybody, this in 2024 was the worst year for home sales in almost 30 years. The last year it was this poor was 1995. Again, that's reflective of the high interest rates, the high prices. If you are in a house that has a low mortgage or no mortgage, and you're forced to move across the country and take out a new mortgage, that's going to be very painful financially for people. So the housing market is really kind of locked up right now. And we'll talk more about the immigration and lack of construction workers and the potential impact of deportations here in a minute. So I'll go ahead and turn this over to the manufacturing. I think it's something interesting, Trey, is I was kind of surprised to see this spike up, but I think you have a good reason for that.
Yeah, so manufacturing activity is what we're looking at here. Blue is the new orders portion that kind of leads manufacturing activity, and then the black line there is just the overall index level for manufacturing sentiment. So we're seeing a spike up here in new orders up to 55, solidly in expansion territory. We'd like to see that corroborated by sub indices like production and activity, but we are not. What we are seeing really is a front running of some of the perceived tariffs that are coming down the pipeline from the new administration. So it's really just a pulling forward of the order chain. It is enough to get manufacturing back up to positive, just below 51. That's the second time in over 3 years that it's just peeked its head above water. It's going to need a bit more than some of the tariff front running to really get a few breaths of fresh air. So far, this is just kind of a gasp here. Why we're so cautious on this is because of the services activity that you're now looking at. So both the headline and new orders for services activity continue to decelerate. We're just in expansionary territory here. This is important. Services is a big portion of the economy, about 2/3 of the economy. And so as spending slows, as services activity slow, the recession generally is at our doorstep here. We're pretty close. So you've unfortunately seen manufacturing improve a little bit, but services decelerate. We'd want to see these move in unison. We are not seeing that yet. So that's kind of the good and the bad news there. We'll kind of leave that and go to profits. Profits is the next portion here. And so on the chart you're looking at here, the yellow line is the earnings estimates for this year. The white line's the S&P 500. You see that they've kind of diverged quite a bit there. Now, earnings estimates when we came into 2024, were quite high. They have decelerated lower by over about 10 points there. We did finish the year for 2024 with some earnings growth there, just through 10%. All of that essentially came from the top 10 biggest companies. You know them, that's the NVIDIAs and the Microsofts and the Apples of the world. Outside of that, earnings were generally flat or negative for the rest of the S&P 500. We did not see any earnings growth in these small cap sectors. So again, a lack of cooperation there and the strength of earnings. And so as we roll through 2025, we want to be very cautious there as those earnings have decelerated and the price has gone higher. We have seen valuations expand, which means the risk premium you take to own equities has gotten incrementally higher. So we want to see the opposite of that. Last portion we'll finish off. Most important is the the employment section. What we're looking at here is initial claims for unemployment in light blue and the continuing claims for unemployment in gray. And so the initial claims for unemployment have really been trading in a range of about 220,000 a week to 250,000. Good news is that they are not ramping higher like we would see as we are entering into a recession. That has not been happening. The bad news is that continuing claims is rising, just like we see as we're going into a recession. What that calculus shows us is that hiring activity is incredibly slow. Layoffs are benign for now. But if you are unfortunately finding yourself unemployed, you are not finding a job very quickly. Plenty of stories to corroborate that. So that's the good and the bad there. The last one we'll finish off is the unemployment rate. And there is some good news there. We've seen some stabilization in the unemployment rate. If you remember, kind of late summer last year, we got a big uptick in the unemployment rate to 4.3%. We triggered the SOM rule. The Fed started putting out language that they were going to cut aggressively, and that everyone on the street had thought we're in a recession. This kind of came out of nowhere, and it's really strengthened. We've since seen a stabilization in that. That's good news at 4%. The bad news is that we're still above kind of the recessionary trigger there, that gray line, which is the simple moving average of about 2 years. Generally, when you get unemployment moving up above its averages there, it starts to portend a recession. So we're still in that area where we want to be cautious there. The good news is we've seen some stabilization. So that wraps up employment there. We'll kind of move on.
Yeah, Trey, before we leave this, one comment, we talked about this earlier today. These numbers do not reflect the federal workers who are being laid off or have taken packages since Trump administration has taken office. Do you have any idea about how many people you think are going to be added to the unemployment ranks, and what do you think that's going to do to these this slide and the prior one?
Yep, so we're 1 month into the Trump presidency, and we've got a lot of talk, a little bit of action, but not enough to measure quite yet. One piece of data we saw today with initial claims as they printed for the week was we see a big uptick in initial claims for unemployment coming out of Washington, D.C. Some of that is to be expected post-election season. What we're seeing is kind of a draining of the swamp. What's also happening is a big inventory spike in Washington, D.C. homes for sale. Inventory is rising aggressively as people are moving out there. In terms of the balance of the year, one of the initiatives that the Trump administration has really tried to push for is a reduction in federal hiring and federal spending. So betting markets right now, as measured by Polymarket, have the federal government employees being cut by over 350,000 jobs, which would equate to roughly 15% of the federal payroll. Even more important is through the DOGE efforts, we're canceling federal contractors and canceling some of that spending. And there's about 10 million jobs that are associated with federal contractors that are not directly employed by the federal government that are starting to get canceled left and right. We'll give a little color on this later, but the balance of that is less people on your payrolls, and you're going to see that unemployment rate spike, and less people to produce all the production that you have coming through. There's some of that we're already starting to see, but I think this is a small indication of what's to come through the balance of the year.
And I guess what that leads us to the next slide. The Federal Reserve is very concerned about inflation. They don't want to repeat of the 70s, and they were talking about more significant rate cuts happening, and that's really slowed down significantly. So Trey, what do you see the Fed doing this year and then next year?
Yeah, so right now markets have priced in between 1 and 2 cuts for the year. getting us down to about 425 to 400 basis points, so 4 to 4.25% on the federal funds rate. Just a few months ago, we were looking at potentially 6 cuts this year, which would take us down to almost 3%. And that's backed off as recessionary fears have kind of slowed down and calmed down. What we will see through the balance of the year as investment slows through tariffs, layoffs begin to happen through federal spending cuts. Growth is already coming down. We did have a GDP miss over since the last time we've talked. Real GDP is down to almost 2.3%. So growth is slowing. That's going to get the Fed, while they're currently patient now because of the uncertainty of the administration, that's going to start inviting in more cuts. So I think this 1 to 2 cuts that we're looking at now, I think if things develop as they are, we're potentially looking at 3 to 4 cuts for the balance of the year, with more stacked for 2026 as the economy really starts to hit the brakes. That'll be good for bonds. Yields will go lower. Stocks will kind of wobble in that instance. We can remove some speculation. Let's not kid ourselves. That's a good thing that we can get back to a more normal environment.
So let's talk a little about NVIDIA and this big price drop we had because of the DeepSeek.
Yep. So in late January, we had kind of over the weekend, really out of the blue, news that kind of broke on a Chinese AI startup called DeepSeek. It unveiled a cost-effective artificial intelligence model that sparked a lot of concerns amongst global investors about potential threats to the established AI leaders like NVIDIA. This announcement initially led to a very significant sell-off in tech stocks. NVIDIA experienced a record one-day market value loss of almost $600 billion. That stock was down almost 20% in one day. It finished the day at almost 16%, as you see on the chart there. Since then, we've seen analysts, the fears around this DeepSeek threat kind of abate a little bit. They've downplayed the immediate risk, and noting that ongoing AI investments continues to support some of the demand for NVIDIA products. DeepSeek was a model created in China with very little capital input. The reports, which we take them with a grain of salt, but the reports were somewhere between only $6 and $10 million worth of training credits to get this model to be as efficient and almost as efficient as some of the leading US models like ChatGPT, Gemini, Perplexity, Grok, etc. The money that's being spent in the US is hundreds of billions of dollars to secure chips, train their models to get them to the leading edge of the frontier. When China came out with this news that they were able to do more with less, it sent a wave through the investment community that maybe we don't need to be spending this money, and maybe this market is far more fragmented than we thought. The fact that these largest companies in the world are setting records and one-day declines, we've said risk happens fast, and this is another example. Yes, some of these gains have been retraced in some of these names, but the genie is out of the bottle. CFOs around the street are looking at this and saying, maybe we don't need to spend this type of CapEx. So stocks like NVIDIA and other AI peripheral names are potentially going to see a hit from this and a reduced investment cycle. And this bubble that we've seen is going to slowly start to pop. This is kind of a risk that not a lot of people had on their bingo card that has come to fruition. I do not think we're going to see elimination of this. I think this is a trend to continue. It will help other countries like China that are investing in this space, and it will hurt some of these overvalued tech names here in the US.
And I think one thing that's important, everybody on this call, you can do a one-day look on Orion with your performance, how your portfolio held up. So when NASDAQ and S&P were down significantly, majority of our clients' portfolios were actually up on the 27th when this happened. And it also, we can go look back to August 2nd to August 6th, and the defensive posturing has worked well for you. So those of you who are heavily invested in this space, trailing stop losses are something you should have in place in case something does happen, like another DeepSeek event or another Chinese competitor comes out that's unanticipated by the market. So, Trey, let's shift our gears now to immigration, because this information I found quite shocking, about how many people are doing work in our country that are not legal.
Yeah, exactly. So, 1 month into the Trump presidency, what have we seen? And what is under the microscope? So, what we're looking at here is a chart of different sectors of the economy, generally blue collar work, and what portion of them are unauthorized immigrants here illegally, and what portion of them are authorized authorized immigrants. And so, it's landscaping, it's private household helps, maids, stuff like this, cleaning services around the house. Of course, construction activity. What we see is some of these sectors are made up of, 50% of the shares of their workers are either authorized or unauthorized migrants. As the Trump administration has made it clear, both through policy and effecting, because we have some evidence that they are processing deportations, this is going to negatively impact a number of these industries, and reduce activity, reduce hiring, reduce payrolls, and reduce aggregate demand as we have a tightening of the labor supply. A lot of people who are doing these jobs will not be there. We've seen anecdotal evidences of construction sites who are having large swaths of their employment not show up to work because of either they've been deported or fear their own deportation, so they're self-deporting. This can have a material impact on the very cyclical sectors of the economy here and can slow us down in a very quick way. We alluded this late last year when we said a lot of these Trump policies could actually be anti-growth in the near term, which I think shocked a lot of people. But the first measure that we've really seen is on the next slide here when we look at construction job openings. And so we get a JOLTS report and we can look at the different industries there that report. In terms of the job openings by the construction industry, we saw a big miss in the number of job openings for construction at 217,000 annualized there. And so what we're seeing is as these migrants are having to go, the reverse flow of the migrants are taking effect, it is having a material impact on construction. I said this before and I'll say it again. All of these migrants that are here that have been receiving government money, the government's borrowing money and giving it to these migrants and it's spending through the economy. The government has been the big bankroll for the past 18 to 24 months. That is in reverse now. And so you're going to see lower payrolls, higher unemployment rate, and lower aggregate demand as these policies take in effect. We are going to slow down in a real way and get back to something more normal. But it's going to sweep some of the legs of the economy and the market that have been so strong over the past few years because they're not organic growth. They shouldn't be happening in the first place. We should not be spending like we are at war when we are not at war. I think this is a good thing to wind down some of the federal spending. It is having an impact here, and that's what this chart is showing you.
Yeah, I think one potential solution, all these Fed workers in D.C., they're in the swamp. They had to put on a tool belt and a hard hat and hit the construction sites to kill two birds with one stone. Anyway, trade uncertainty. When you have this kind of uncertainty, you have big companies, they're hesitant to deploy capital. And this is the trade tariff reaction. So Trey, why don't you expand upon what you're seeing in this area? And what do you think companies are going to be doing?
Yeah, so 44% of the S&P 500 have discussed tariffs on earnings calls this quarter. And so that's the chart you're looking at here. The blue line is just kind of the trade policy uncertainty index there. And the gray line, which is really mimicking it, is the share of S&P 500 companies that are discussing those tariffs. One of the positives we've seen is the front running of orders to try and get them ahead of some of those tariffs that will be coming on primarily from China. Another aspect of it is how do you invest around such uncertainty? And the answer is you just generally don't. You start to cancel projects, you lay off staff, you get lean in face of the uncertainty to try and get through it to a more clear skies. So this uncertainty that is coming around trade policy, which will no doubt restructure some of the global trade that's going on for good reasons. It's going to weigh on some of the investment that these companies are going to do, both at the company level and at the economic level, as supply chain uncertainty is very high. So this is something we want to watch out for. We think this is a trend that will continue. This is very important in terms of one of the big items for the Trump policy there. So leaving that, we'll kind of go on to the next slide.
Yeah, Trey, but I want to add something. I got a message from one of our clients who works for a large pharma Fortune 100 company, and they don't even have a budget yet for 25. They don't know what they're going to do, then how many people they're going to have, they're going to lay off people, what projects they're going to do. So that's just one data point that supports this chart. This next slide talks about the impact of the higher interest rates on the real estate market. We're starting to see some more pressure because high rates over a long period of time do cause certain industries to have problems.
Yeah, exactly. So looking at here is just kind of the percent of loans out there that are delinquent or having specially serviced loans, serviced loans, which are just another way of saying restructured loans. And so you're able to look at the real estate industry, everything from multifamily and office to hotel and self-storage. And so you'll see that while industrial is doing really well, office has been the pain point as the work from home has changed the dynamics for office space. But as you'll see through the colors of the charts, if we've gone through 2024 and got through late 2024, as yields are starting to pick back up there, the stress has come back into the real estate market in a very material way. This is one of the areas of the economy that has just really not been doing well. Mitch just told an anecdotal story about the pharma. We've had clients reach out that are in the construction space that paint a very bleak picture. I know real estate agents are having a very tough time right now. Unfortunately and sadly, a lot of them are delivering groceries or driving Uber to try and meet ends meet. And to say to them, well, don't you know NVIDIA is up? It's just so disrespectful. There is pieces of this economy that are really going through it right now. And it's only going to spread. We don't like these things. But that is what's happening. It will eventually get us back to normal, hopefully to sunnier skies. But this just shows that there's a lot of property stress out there right now. Yields are hovering between about 4.5% to 4.8%. We'd like it to see it kind of stay around there and slow things down. If that is, we're going to continue to see stress bubble up in the property market there. Leaving that, we'll kind of go to one of the last slides here. We'll talk about kind of the retail sentiment. So this chart here comes from JP Morgan. It is a kind of a view it as a standard deviation of retail sentiments. Retail sentiment being defined by everyday mom and pop traders, non-institutional, where generally they're defined as uninformed, unsophisticated traders. So as sentiment is very high here, you can see that on the right there where the red bubble is. Sentiment being very high means mom and pop traders are all in on the market. All the chips are on the table and they're very, very bullish here. And that's generally seen as a contrarian indicator. If everyone is buying, the only people left are those to sell. And so we saw this kind of going into 2022, similar readings, everybody on the bullish side. When you get people on one side of the boat, you eventually risk capsizing, something we want to be cautious of here. And then Mitch, I think you've got one really, really good slide here that kind of leads into, I think it talks about forward returns on markets.
Yeah, and Trey, this is one we talked about. I'll go and talk a little bit about this. We're actually using this in our meetings right now. And this is a regression analysis showing expected returns for the next year and for the next 5 years. And when you have a higher elevated PE ratio, and this is from December, and Trey on the earlier slide, I think it's what, 25, 26 now on the S&P. So it's gotten significantly higher. So when you have a high PE, and that's what this x-axis is for both of these, and then the y-axis is the future rate of return. So if you got a PE in this area here, this red diamond is the expected return for the coming year, and it's barely positive on the S&P, and there's a lot of negative data points that this is 20% a bear market. But I think what's important is if you look at the 5-year, you get a lot of the dots get on top of each other. It gets to be a little bit easier to see. Again, you see a low expected rate of return because of an elevated PE ratio. So what does this mean? This means that index investing, a lot of people have been doing for the last couple of decades, will not do as well going forward. That means individual stock selection, individual countries or ETFs that are not very thought of very highly, and we'll talk about that on the next slide, are going to be places you want to put money. And that's where our expertise comes into play. Many of you were investors in the aughts from 2000 to 2010. And if you want to guess what the S&P did, just think about it, write it down on a piece of paper or tell your significant other what the rate of return was for that 10-year period. And the answer was 0. Now you've got maybe 1% with dividends, but you had 2000 through 2002, you had 3 negative years. 08 was obviously a big negative year. So for 40% of the decade, you had pretty big losses in the market. And if you weren't in small cap value, emerging markets, or private REITs, you really didn't make any money for 10 years. Now, we don't think that's going to happen for the next 10 years. But when you look at these statistical charts, it doesn't bode well for indexing. So you got to be nimble and average, nimble and above average, and be able to find positions where to put money where you can make money. And that's what we want to show on this next slide here. Trey touched upon about this earlier about investing overseas. Why don't you expand on what we're looking at here, Trey?
Yep, so this chart is just a contrast here. And so on the top portion, you have the USA price return valuation. So this is going to be your forward PE multiple for your total US market here. As you'll see, it's quite elevated. We've only been at this level in 2021 and 2000, right before the tech bubble. And that's going over a 30-year period there. So generally forward returns came very hard very hard to come by, and they came with a lot of risk. And so that could be worrisome, except we have a global market portfolio to tap into. And so the bottom portion is the contrast to that. And so we juxtapose that with the all country world index if we just strip out the United States. And what do those valuations look like? Is it real scary there as well? And it's actually not. We're materially below the average there over 30 years there. And so we can win through valuation expansion and earnings paying us. And so we can invest outside of the borders. We think that's going to be a good theme going forward over the next 5 years or so. And we mentioned at the beginning of this webinar, I'll close the same way we began, that the theme for this year has been very different. We've been singing a very different tune, and most of the returns this year have come outside of our borders. And that's because people know that these stocks are overvalued and they're looking for somewhere to go. There are opportunities emerging through Europe and Asia that are starting to look better. China is a market that's up 17.5% this year, while the S&P is up around 3.5%. Europe, which has much lower valuations, is up over 9% versus the S&P's 3.5%. The emerging markets up 7.5% versus the 3.5% here. And so these trends, if they're really starting to get going, there's a good long wave to ride them. There are opportunities out there. We'd be happy to take them if they can come to us here. And so there's no concern for us. We can make sure we can hit our return targets, get you to and through retirement. Plenty of opportunities out there, and you don't have to take the risk that the U.S. markets currently offer.
And Trey, why don't you tell the group what we did last year with the China index and what we've been doing the last couple of 3 months with some of our specific international trades?
Yeah, so last year we without going to the well too much, China caught an initial bid at the end of last year, at the beginning of last year. And so we were able to kind of get a portion of our portfolio, about 6 to 8% across the models in China, spiked up, ended up selling out between about 35 to 40% gain over a few months there. Kind of reset. Some optimism has come back into the Asian market. A couple of green shoots, economy starting to find its footing. We've seen a number of good anecdotal pieces of evidence out there. And so coming into this year, we kind of thought that maybe we'd see another resurgence in Chinese equities, Asian equities as a whole. So we've been able to allocate outside of our borders between the models, anywhere from 5 to 12% of the models. And the returns have been good. They've come to us pretty quickly. So we're making sure we kind of manage some of the risk. Can't go broke taking a profit. We want to make sure that we understand that trees don't go to the sky. But there's potentially many more legs of this. Some of those holdings are up 50% in a matter of 4 to 6 weeks. And so there are opportunities. You don't have to invest in stocks that maybe they go up 20, 30% in the next few months, but you might get an over the weekend warning and your stock is down 20%. There are ways to play this without having to assume that type of risk. Asia has been a place. Europe could potentially be another place for us there. These trends could have a long way to go. If they are, we will make sure we're continuing to align there. Over the past 6 months, we've been moving more and more money to lower risk areas that still present material gains. That's where we've been able to benefit from. That's how we've been able to ride this. And I think that that's a win-win for everybody.
Thank you for that commentary, Trey. As we wrap up, this last slide basically just shows our income producing portfolios. We're still producing the level of income that we told you guys we would. Again, the indexing, which is Advantage, which has done extremely well. We don't anticipate it's going to be doing 7% annually. It's going to revert back to 5%. Stock income, which we have a pretty good chunk of it sitting in bonds because of the conservative nature, and we're just trying to be protective of capital and produce income, is a little bit below the 8% target. That completes our webinar. We'll go ahead and turn off the recording and